Congressional hearing puts Bitcoin and DeFi in the hot seat. An interview with a congressman followed by a congressional hearing on crypto signal policymakers are moving to the next phase of talks about regulating crypto. Foster has historically been a champion of the crypto market. He's a co-chairman of the Congressional Blockchain Caucus and was previously supportive of the future of crypto. However, in his recent Axios interview, his tone flipped, as he went as far as to suggest the need for a cryptographic backdoor to allow the court the ability to view or even reverse transactions. Is Foster's new viewpoint indicative of a greater shift in policymakers' attitude toward crypto regulation? Today's House Committee on Financial Services hearing with a particularly colorful title is yet another signal for an upcoming regulatory push in crypto. It is Wednesday, June 30th, and today, we are talking about a congressional hearing that is putting Bitcoin, crypto and DeFi in the hot seat. It's like saying that if someone buys cigarettes or alcohol or condoms with cash, they're part of a criminal conspiracy. As we'll see, I believe that lawmakers right now are more likely to want to ban cash than to accept anonymous crypto transactions. Anyway, I wanted to get my 2 cents on the absurdity of this whole line of reasoning out of the way so that we can focus on the tonal shift. For most regulators, so far, the crypto industry has been at best a tertiary concern. But the point I want to make is that it doesn't take a cabal of anti-crypto communists or something for serious negative sentiment to begin to prevail. But then this morning, the House Committee on Financial Services announced the hearing today about the end. For now, let's glean what we can about the positioning based on 1, the committee memorandum about the hearing, and 2, the prepared testimony of invited witnesses. They note mainstream financial players like State Street and BNY Mellon have set up new digital asset divisions, and that globally 98% of hedge fund managers plan to start to invest in digital assets within 5 years. I believe that one of the main trends shaping markets now is that individual retail investors are saying I want in en masse, and this is shaping everything from ETFs to crypto to meme stocks. These investors are often disaffected coming in. They view financial markets as a game slanted towards the rich getting richer and are just trying to carve out their little piece. I think denying them access to markets in the name of protecting them from themselves would be a catastrophically paternalistic response, whether it's in the name of investor protections or not. Now, at this point, it probably goes without saying, but I've seen absolutely no evidence of systemic risk, especially spilling over into the broader system. And by the way, you would think that with a claim this serious, this notion of crypto becoming a systemic risk, that it better be some pretty profound experts behind it, right? Don't move your money from bear, that's just being silly. They discuss the SEC not approving Bitcoin ETFs because of market manipulation and fraud concerns, but they also go in on DEXs, decentralized exchanges, quote, the emergence of peer-to-peer decentralized cryptocurrency exchanges, DEXs, which are not contemplated by current government regulation, has led to another avenue for cryptocurrency scams. They argue that, quote, cryptocurrency exchanges also frequently face network congestion or trading halts, calling into question their readiness to serve a growing marketplace, which is rich again to me, given how many times recently trading has been shut down in traditional markets around the stocks that investors most want. The penultimate section of the memorandum is called Enforcement Activity Against Cryptocurrency Market Participants, and it basically just repeats that Gary Gensler from the SEC wants clear authority over crypto exchanges, which, frankly, wasn't what many heard in his previous testimony, but if this is what we'd get with the House in control, I'd take it. Now the last thing is an appendix of recent actions, and I think it's a really telling catalog of how they see the highlight events of this year, so let's rip through it. January 2021, BlackRock adds Bitcoin futures as a potential investment for 2 of its funds. March 202, again, Morgan Stanley, New York Life, Mass Mutual, Soros Fund Management and others announced participation in a $200 million investment round in ADIG, a firm leading Bitcoin-related strategic initiatives that span investment management, insurance and banking. April 26, 2021, Tesla reverses course and sells its Bitcoin holdings citing environmental concerns, making proceeds of $272 million. May 6, SEC Chairman Gary Gensler calls for greater investor protections in the cryptocurrency marketplace, including crypto exchanges. Chair Gensler warns FSC members that right now these cryptocurrency exchanges do not have a regulatory framework at the SEC or at our sister agency, the Commodity Futures Trading Commission. Right now there's not a market regulator around these crypto exchanges, and thus, there's really no protection around fraud or manipulation. May 11th, SEC issues staff statement calling Bitcoin a highly speculative investment, warning investors and mutual funds that trade Bitcoin futures about their potential exposure to hidden risks. June 10th, SEC and CFTC issues investor bulletin urging investors to carefully consider the volatility of Bitcoin and the Bitcoin futures market, as well as the lack of regulation and potential for fraud or manipulation in the underlying Bitcoin market. So, I would say that the two things that stand out here are 1, a clear focus on growing institutional participation, and 2, a 100% increase followed by a 50% decline in the price of the Bitcoin asset within 6 months. First, from Alexis Goldstein, the Director of Financial Policy at the Open Markets Institute, she writes a long set of prepared comments, but let's just highlight 2 things. The first is that she, unlike Jim Cramer, outlines a rationale of how crypto could become a systemic risk. Basically, her argument is that if hedge funds get deep enough that they could have an Archegos-style implosion based on crypto volatility, that's how crypto risk could become a larger market risk. I think it's important to note, and she does here, that this is not necessarily, or at least not just, a crypto issue. It's an issue of the opacity of hedge funds, which is something that the traditional finance space has to reconcile with completely independently. Her big thing is just like, regulation is both important and really tricky. First, it's hard to determine how a particular digital asset that isn't Bitcoin or Ethereum is characterized from a regulatory perspective. While crypto haters might think this is good, it isn't, because a lack of regulatory clarity harms retail investors. Quote, while a number of recent fintech innovations depend on a partnership with a regulated banking institution, DeFi seeks to disrupt this model entirely by eliminating the regulated intermediary. And by the way, this one is super helpful if you just want the 101 on what regulatory conversations have already transpired. This probably would find some allies within the crypto community, or at least, there would be a tension between the desire of many for reserve attestations, something Nick Carter, for example, has been talking about forever, and the desire for those sorts of things to be voluntary, rather than mandated from on high. There are a couple of key shifts in perception he tries to make. First, around the idea that crypto isn't regulated. That's wrong. It's regulated all over the place at the state and federal level. Peter's key line, we don't need new regulations. Quote, with the rise of central bank digital currencies from authoritarian nations happening in tandem with the rise of Bitcoin, we are at a decision point as an advanced technological open society. Are we willing to accept some risks if it means we can eliminate the choke points to economic participation that further inequality and stifle innovation?